Accounting choices and estimates are fundamental components of financial reporting because many business transactions cannot be measured with complete precision. The program explains that accounting standards often allow companies to choose among acceptable accounting methods and require management to make estimates regarding uncertain future events. These decisions influence reported revenues, expenses, assets, liabilities, and profitability measures. Analysts must therefore understand how accounting choices and estimates affect financial statements because different assumptions can materially alter reported financial performance without changing the underlying economics of the business. Careful evaluation of accounting policies helps analysts assess earnings quality, compare companies consistently, and determine whether reported results faithfully represent economic reality. Accounting choices arise because financial reporting standards permit multiple acceptable methods for recognizing and measuring transactions. Common examples include inventory valuation methods such as FIFO or weighted average cost, depreciation methods such as straight-line or accelerated depreciation, and cost versus revaluation models for long-term assets under IFRS. The program emphasizes that management may select accounting policies that either increase or decrease reported earnings depending on strategic objectives. Aggressive accounting choices generally accelerate revenue recognition or defer expenses, while conservative choices delay revenue recognition or accelerate expenses. Analysts evaluate these policies carefully because accounting method differences can significantly affect profitability ratios, leverage measures, and comparisons across firms and industries. Accounting estimates are necessary when future outcomes cannot be known with certainty at the reporting date. Examples include estimates related to bad debt expenses, warranty obligations, pension liabilities, useful lives of assets, impairment testing, and contingent liabilities. The program notes that estimates require management judgment and therefore introduce uncertainty into financial reporting. Because many estimates depend on assumptions regarding future economic conditions, small changes in assumptions may materially affect reported earnings and balance sheet values. Analysts review disclosure information carefully to evaluate whether assumptions appear reasonable, consistent, and supported by operational trends. Excessively optimistic estimates may overstate profitability and asset values, while overly conservative assumptions may understate current performance. Changes in accounting policies and estimates also affect the comparability of financial statements over time. Changes in accounting policies generally require retrospective application, meaning prior period financial statements are restated to improve consistency and comparability. In contrast, changes in accounting estimates are typically applied prospectively because they reflect new information or revised expectations about future events. Analysts must distinguish between these changes because they influence trend analysis and earnings interpretation differently. Frequent or unexplained changes in accounting methods or assumptions may indicate attempts to manage earnings or improve reported performance artificially. Understanding the rationale behind these changes is therefore essential for evaluating reporting quality and management credibility. Management incentives often influence accounting choices and estimates. Companies may face pressure to meet analyst expectations, satisfy debt covenants, maintain stock prices, or maximize performance-based compensation. These incentives can encourage earnings management through aggressive revenue recognition, delayed expense recognition, or optimistic valuation assumptions. Analysts therefore examine financial statement disclosures, unusual accounting adjustments, and trends in estimates carefully to identify potential reporting distortions. For example, declining bad debt provisions despite rising receivables or unusually long asset useful lives may signal aggressive accounting practices. Evaluating management behavior and incentive structures helps analysts determine whether reported earnings reflect sustainable business performance or are influenced primarily by short-term reporting objectives. A strong understanding of accounting choices and estimates is essential for effective financial statement analysis, valuation, and investment decision-making. Analysts integrate quantitative analysis with qualitative evaluation of accounting policies, management assumptions, and disclosure quality to assess the reliability of reported financial information. Transparent disclosure of accounting methods and estimation assumptions improves investor confidence and enhances comparability across companies and reporting periods. Because accounting choices and estimates significantly influence earnings quality, asset valuation, and financial ratios, careful analysis helps identify potential risks and warning signs of lower quality reporting. By understanding how management judgment affects financial statements, analysts can interpret reported results more accurately and make more informed investment, lending, and valuation decisions.